We have a special guest, Avana, William Foster, who's taken our time all the way from New York. It's way past midnight there to speak with us. He's Vice President, Sovereign Risk Group at Moody's Investor Service. And they've come out with their note on the budget, talking about how they expect the government to achieve their fiscal deficit targets. William, great to have you on the show. Thanks very much for taking out the time. What have you taken away from the budget? And, given that you believe FY18 budget is credit positive, would Moody's be looking at finally making a move on upgrading India anytime soon?
So we certainly thought the budget was prudent, and it struck a careful balance between fiscal consolidation and balanced growth, which very much supported our positive outlook on India's sovereign credit rating. We will continue to monitor the progress on the reform front, which obviously has been very positive over the last year and quite substantial, obviously, post-monetization and with the pending GST and several other important reforms that have gone through Parliament and pending reforms in the future. We're waiting to see how these reforms are going to impact the economy on the ground ultimately, and to what extent they will contribute to a sustainable recovery in investments led by the private sector in particular. Government spending, which this budget focused on to a certain extent, will help crowd in the private sector investment, particularly in infrastructure, et cetera. But we will continue to monitor the progress on that front, and ultimately that growth can lead to the lowering of India's fiscal debt burden, which is quite high, and that is the particular weakness in India's current credit profile. But over time, we believe that will come down along with the fiscal consolidation roadmap and higher nominal GDP growth, and that's why we have a positive outlook on India's credit.
William, let's talk a little bit about, what the emphasis, what you made of the emphasis of the finance minister in the budget on fiscal consolidation, because even when we were speaking with him, they spoke about how the primary focus of the government this time around was to spend more on rural, agricultural and infrastructure sectors. How exactly do you read into all of this?
Well, the budget was consistent with the previous policy of adhering to a fiscal consolidation roadmap. They veered very slightly from the 3% target that had originally been put in the roadmap for next year to a 3.2% target. But the focus on that was to increase spending in areas where the economy needs a little bit of a boost, particularly in infrastructure, to help, as I was saying previously, crowd in the private sector, but also to focus on the rural economy, which could benefit from additional support to consumption, and particularly looking at roads and rural development in the infrastructure sector, as well as support to irrigation and things like that. So that ultimately is a very smart way to use scarce resources to help focus on economic development, both for those who are at the lower income level, but also in areas like basic infrastructure, which the government really can contribute to bringing in other investment from the private sector. So we believe that it focused both on the consolidation roadmap, but also on key areas of the economy that do require more support from the government and spending in infrastructure in particular.
Right. Surely enough, you're saying that you're comfortable with the fiscal consolidation roadmap put out by the government. This is the third year running that we've been touching base with Moody's and getting their sense of what more they want to see for India to qualify for an upgrade. If you're talking about reforms, there's been the bankruptcy code, demonetization has been a historic reform passed, and of course, while the economy on the rural side is adjusting to that, a major portion of the adjustment has already happened. Add to that, we are looking at a global environment where the fiscal situation with other emerging markets has deteriorated quite a bit in comparison to India. I just want to understand, is it that much tougher, or is it a more prudent call to upgrade an economy's investment grade versus downgrade? Because we've seen a whole host of downgrades coming in from rating agencies, but very few upgrades. So I just wanted to understand, what would it take for you at Moody's to make that call?
You're right. I mean, the trend has recently been toward downgrades, and that's a product of the factors you just mentioned globally, particularly with commodity exporters, and just a more difficult global environment, trade front, etc. And India is very much a positive story in the context of a more difficult global environment for many emerging markets. And that's what our positive outlook focuses on. We, as I mentioned previously, we were going to continue to monitor the progress on the reform front. And what we're looking for in particular really is the continued strengthening of the institutional framework and the macroeconomic framework within the economy that will ultimately lead to enhanced investments that over time can bring down the debt to GDP ratio through both fiscal consolidation and just higher nominal GDP growth, which will also contribute to revenue generation, and policies that will complement that would be ones that, for example, we believe demonetization will ultimately contribute to more formalization of economic activity, higher tax collection, and if you pair that with improved tax administration, you can see an improvement on in terms of the fiscal revenue targets that will combine with higher GDP growth to bring down that debt stock over time. So that's what we believe will ultimately transpire. This budget was consistent with our positive outlook, and we'll continue to monitor to what extent that actually materializes in the economy. And if it does, that's the basis by which we can make an upgrade.
Final question at my end, William. What would be a feasible debt equity ratio to qualify India for an upgrade? Because I know that on the foreign debt to GDP, India is better off than a lot of emerging markets. A lot of other countries, the developed world, of course, has swollen balance sheets. Domestic debt, yes, has been a concern, which the government has made its commitment to tackle. What would be a feasible ratio which would make you sit up and say, yes, enough work has been done on that front?
That's a great question, and the short answer is there isn't one number. It really is relative to the economy itself. The focus of the debt to GDP ratio is really on sustainability of fiscal dynamics and the ability for the economy to sustain a particular debt burden while continuing to grow at a rate where incomes rise and the fiscal targets or the fiscal balance is sustainable while maintaining the general balances both in the economy domestically and externally. And so it's really the totality and of the economy and the equilibrium of various facets of the economy that feed into that debt to GDP ratio. So there really isn't one number. It's tempting to try to pick one number, but it does not work that way. But to give you an example, India's debt to GDP ratio is currently about 68% of GDP. And the peer group that India is in the BAA space in particular, it is about 20% lower than that. But India's economy is very robust, growing at a very fast rate on a relative basis. It's dynamic, competitive, and it has tremendous potential. So that's why India's positive outlook justifies, even though it has a higher debt burden, there are many other aspects of the economy that warrant a positive outlook, because we believe over time that debt to GDP ratio will come down and be more in line with the median peer group. But again, you can't really pick just one number. It's a little bit more complicated than that.
Take your word on that. But I think the government has been working hard enough to ensure that the internals of the Indian economy shape up well, and hopefully soon enough a rating agency such as Moody will also take note of that. Thanks very much, William, for taking out the time to speak with us today. Really appreciate your views and you staying up a bit late for this interview.
It was a pleasure to be with you. Thank you very much.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.